Attention taxpayers, a massive rule change for the 529 plans went into effect at the start of 2024. This rule change has dramatically altered the way that you can use your 529 accounts and the tax benefits that you can get from them. In today's video, I'm going to explain what the key changes to the 529 plans are. I'm also going to provide some additional information about 529 plans for everyone who is not familiar with them or how they work. If you are someone who wants to save for either education costs, retirement, any way that provides with significant tax advantages, then this video is for you. Without further ado, let's dive in. What is the 529 plan? As a quick reminder, a 529 plan is a tax advantage savings plan that is designed to help you pay for education costs. They are called 529 tax plans because the rules for these plans are laid out in Section 529 of the Internal Revenue Code. 529 plans can be used to pay for a wide variety of education expenses, including college, K-12 tuition, apprenticeship programs, and even student loan payments. So who can open a 529 account? Almost anyone can open a 529 account. However, it is common for these accounts to be opened by either parents or grandparents who have either their child or grandchild as a beneficiary for the account. So yes, you can create a 529 plan on behalf of your beneficiary, but you can also create one of these accounts for yourself. So whether you want to help fund your own education or the education of a child or grandchild, 529 plans can be extremely useful. Now, how do 529 plans work? 529 plans work in a very similar way to a Roth IRA or a Roth 401k. That is, you fund the account with after-tax dollars, then your account grows tax deferred. When you're ready to withdraw the funds, you will not have to pay taxes on them as long as you use the funds to pay for qualified education expenses. Importantly, this applies to both state and federal income taxes. So as long as you're following the rules in using the funds on qualified education expenses, you will not have to pay federal or state income taxes when you withdraw the money. If you withdraw the money and use it for anything other than qualified education expenses, the money you withdraw will be subject to an income tax in addition to a 10% penalty. Yes, there are some exemptions, however, such as if the money is withdrawn due to a death or disability. Another important thing to know about 529 plans is that over 30 states actually provide deductions or tax credits for contributions to 529 plans. The amounts of these deductions vary from state to state, but if you're thinking about setting up a 529 account, then you should definitely check to see if your state offers deductions or tax credits for 529 contributions because they can be very helpful in reducing your liability. Okay, now let's talk about the important new changes to these plans that have just taken place. Before the Tax Cuts and Jobs Act of 2017, 529 plans were reserved for post-secondary education costs. However, the Tax Cuts and Jobs Act expanded 529 plans so that they could be used to fund tuition at K through 12 schools as well. Now, some other major changes are going into effect for 529 plans. On December 29th, 2022, President Joe Biden signed the Consolidated Appropriations Act of 2023 into law. Within this act was the Secure 2.0 Act of 2022. In this act, there was a provision that was introduced by Republican Senator Richard Burr of North Carolina that made a significant change to 529 plans, so that starting on January 1st, 2024, qualified leftover 529 account funds may be transferred to a Roth IRA without any tax penalty. This is a massive and extremely beneficial change for 529 plans. Here's why it matters. One of the biggest complaints about 529 plans that many people have had was that they were afraid to add a significant amount of funds to these accounts because of the fact of income taxes and the steep 10% penalty that would be applied to any money that is withdrawn that was not spent directly on qualified education expenses. Guys, this was a big problem because it meant that if the money invested in a 529 plan grew significantly due to good investment strategy, then the account holder would end up losing a ton of money to the government in the form of taxes and penalties if they needed access to those funds. But now, people who take out of the 529 plans are not going to have to worry about that anymore. I cannot stress how important this is. This rule, which is now fully in effect, has completely changed the nature of 529 plans. Now they're no longer just an education savings vehicle whose tax benefits expire when you're done paying for college. They're a tax advantaged account with benefits that now extend all the way until your retirement. We have to start looking at 529 plans completely different. Because of this increased versatility now, it is likely that many tax planners and financial professionals will start integrating these accounts into financial plans much more often. If you're someone who needs both to pay for education costs and retirement costs, then it might be time to start speaking with your tax professional and your financial planner about establishing a 529 plan and seeing if it's a good fit for you. Now, here are the rules for 529 plans with the Roth IRA rollover. It is important to note that even though the government has changed the rules and you're now allowed to roll over your funds from your 529 account to your Roth IRA without being penalized or facing additional income taxes, there are still some rules that have to be followed for this process. The 529 account must be at least 15 years old, and there must have only been one designated beneficiary for the account during this time. The amount being transferred must have been contributed to the 529 account at least 5 years prior to it being transferred to a Roth IRA. The amount of money you roll over to your Roth IRA from your 529 plan is subject to the annual contribution limits of Roth IRAs, which is currently $7,000 or $8,000 if you're over the age of 50. The total amount that you can roll over to your Roth IRA from your 529 plan is also capped at $35,000. Now, I know some of you watching this right now are probably wondering, Karlton, what about income limits? After all, Roth IRAs have income limits. So what if I'm a high income earner? Will I still be able to utilize this 529 plan Roth rollover situation under these new rules? Well, the answer to this question is yes. Even if you are a high income earner, you will be able to roll over your funds from your 529 plan to your Roth IRA under the new rule changes. The reason this is because the government chose not to put income limits for these kinds of rollovers. Guys, this is great news for anyone who is a high income earner who has found success, who wants to save for either their own or a beneficiary's education, who also wants to contribute money to a Roth IRA. In fact, because high earners will be able to make contributions to Roth IRAs through 529 plans, this strategy will act almost like a new form of a backdoor Roth IRA. Let's discuss qualified expenses. Now that we have gone over the major rule changes for the 529 accounts and how you can use them to fund a Roth IRA, I want to take some time to quickly discuss a few other important details about 529 plans in case you don't know them. And don't forget to share this video with at least one person who you think might benefit from this video. Okay, so as I mentioned earlier, you can withdraw money from your 529 plan tax-free to pay for qualified education expenses. Here's a quick list of the education expenses that are considered qualified. You can pay for books in school. You can pay for supplies, elementary or secondary school tuition and fees, college, graduate, or vocational school tuition and fees, student loan payments, off-campus housing, campus food and meal plans, computers, internet, software that is used for schoolwork, and if you have special needs and accessibility equipment as a student. So you can use funds from your 529 plan to pay for any of these expenses for you or your designated beneficiary without having to pay any tax on this money. Let's discuss some contribution limits. Another great thing about 529 plans is that they have extremely high contribution limits compared to many different types of tax-advantaged accounts like the 401k or the IRA. In fact, there are actually no yearly contribution limits for 529 plans. Instead, there are aggregate contribution limits, which are the total amount that you are allowed to contribute to these plans. Each state has its own aggregate contribution limit for 529 plans. These aggregate contribution limits range somewhere between $235,000 upwards to $531,000. Now, keep in mind that many states actually offer multiple 529 plans, and sometimes these plans have different aggregate contribution limits. So, in order to know what the exact limits are for the plan you're considering, make sure you do your research to see what the limits are for that particular plan in your particular state. All right, guys, we've covered a lot of information about 529 plans in this video, and congratulations on making it this far. I was excited about this one. Here's a quick recap of the most important points that I covered in this video that I want you to walk away with. Number one, there has been a massive rule change to 529 plans, and now leftover funds in 529 plans can be rolled over to a Roth IRA without any additional income tax or penalties. Number two, this means that 529 plans can now be used both to help fund education costs and to save for retirement, which gives them much more flexibility. Number three, the total amount that you can roll over from your 529 plan to your Roth IRA is $35,000. The new rule for rolling over a 529 fund to an IRA went into effect at the start of 2024. If you have any questions about 529 plans or rolling over leftover 529 plan funds into a Roth IRA, then feel free to get in touch with my team by clicking on the link in the description below. You can also find a link in the description to my ebook, The Short-Term Rental Rule. This ebook teaches you how to use short-term rental real estate to lower your tax burden for your W-2 income and your 1099 income. Now, additionally, I've also included a link to my free webinar in which I teach you how to use the same strategies that the top 1% of all the wealthiest of Americans use to lower their tax bill by 70% or more. So if you want to cut your tax bill down or cut it in half, you're definitely going to want to check this out. Finally, I've also included a link to a resource on how to set up your LLC correctly. If you'd like to work with my team on setting up your LLC, we wanted to make sure that we provided a link that will help you move in the right direction. So I highly recommend that for you. Okay, that's all I got for you guys today. I hope you enjoyed this video and that you found it valuable. As always, don't forget to like, comment, subscribe. Let me know what you think about this new rule with the 529 plans. Let me know your thoughts below in the comments. I look forward to reading them, and I look forward to seeing you on the next video. Cheers.